Hello, everyone. Good afternoon, good early morning to some, and welcome to the first session of the 2021 Virtual Conservation Finance Boot Camp. I'm Leigh Whelpton, Director of the Conservation Finance Network, and on behalf of my colleagues and our partners at Hysted, the Yale Center for Business and the Environment, we very much thank you for joining us and are excited to be together this week. A few quick housekeeping notes. This session is being recorded, as we warned you just a moment ago. But on the upside, recordings of all 4 webinars in the virtual bootcamp series will be publicly available on our website at a later date for you to rewatch, to share with your colleagues, etc. Participants will be kept on mute throughout this presentation, but we do ask that if you have questions, you go ahead and throw those into the chat box. We'll be monitoring, we'll make sure we get to as many of them as possible. We are going to try to do those at the end, unless there's something that's just very urgent and we'd like to address in the moment. We also invite you to engage and share any ahas or takeaways that you find significant on social media, whatever platform of your choice. We're using the hashtag CFNBootcamp just to track and monitor and interact with you all. So we invite you to do that. And we'll drop that into the chat box in just a minute here. And lastly, many of you beat me to the punch, but we'd like to have as much interaction as possible over the course of the week and ask that we help kick that off, or your help kicking that off, by sharing your name, your organization, and your location in the chat right now as we're getting started here. So next slide. This session is the first in our 4-part webinar series for the bootcamp. To share a quick glance at what to expect, we'll be back on after this session at 4 o'clock Eastern today for the Principles of Finance with David Hoffer, followed by a happy hour debrief and discussion, a veritable group therapy session for your funding and financing frustrations and challenges. Tomorrow we'll reconvene at 2 p.m. Eastern for a series of panel discussions rounding up trends and innovations across the field. And on Thursday, we'll be back in action for our final session at 2 p.m. Eastern, a panel featuring the ARCH framework and case examples for best practice in project development. So let's kick things off. I am joined today by my colleagues and co-presenters, Peter Stein, Managing Director of the Lyme Timber Company, also co-founder of the Conservation Finance Network, Helen Rogers, CFN Manager, and Jackson Moller, CFN Associate. We are also well supported by CFN intern Hallie Sachs and our partners and friends at Hysted and the Center for Business and the Environment at Yale, including but certainly not limited to Tara Whalen, Spencer Meyer, Katie Michaels, Alec Applebaum, and Heather Fitzgerald. Our task at hand today is to demystify what exactly we mean when we use the term conservation finance, which approaches are well established, what does emerging activity and innovation entail. This 101 session of sorts will provide an overview of how conservation finance approaches have evolved, exploring those trends and the range of funding and financing strategies being put to work for land and resource conservation, restoration, and stewardship. We're slightly biased towards the US legal code and context, but we do have fuzzy boundaries in the analogy for how these case examples can be shared or understood. And if you put in the chat box for an example from somewhere else, chances are good that we'll be able to speak to something that should fit the context of somewhere else. Today, we'll also be speaking from the perspective of a professional who's sat in a chair at a desk trying to craft some solution to a conservation, restoration, or stewardship problem, whether that involves land acquisition, community partnership, ecotourism, perhaps hydrologic restoration, climate resilience, green infrastructure, equitable economic development, what have you. The aim will be to think about how the blending of different tools and incentives can help secure the capital resources you need for that particular solution, whatever the underlying resource challenge. This is a pretty brief introduction in 75 minutes or whatever time remains. So for a deeper dive, we do have a number of other webinar recordings available an especially great set of toolkit resources on particular case studies and approaches, articles, and other things that can help to guide you along your exploration. I'll also just start out the gate by recommending 2 books, both available from Island Press at a 25% discount using the code CFN25. For those most interested in dipping a toe in the water beyond conservation easements and land acquisition, we recommend A Field Guide to Conservation Finance by Story Clark. And for those coming perhaps more from the funder or investor perspective, or those with more advanced transaction experience under their belt, we would recommend Valuing Nature, a handbook for impact investing by Bill Ginn. Now I'm going to hand things over pretty quick here to Peter Stein to walk us through where this innovation has come from and how it evolved. Peter, over to you.
Great. And let's go to the next slide. So as Leigh indicated, I'm one of the co-founders along with Story Clark and Brad Gentry of the Conservation Finance Network. I have either been an innovator or a bumbler in conservation finance for more than 4 decades. I was lucky enough to be one of the founding staff of a national land conservation NGO called the Trust for Public Land, wonderful organization. And then about 29 years ago, I moved on from the Trust for Public Land and became a managing partner, managing director at the Lyme Timber Company, a timberland investment management organization that has pioneered a number of conservation innovations over the years. But I thought I'd use this timeline a little bit to connect my personal career to various pivot points and innovations in conservation finance. Early on, I was lucky enough to be riding in an elevator with the board chair of a small family foundation in New York City. And we had enough time. It wasn't, the elevator didn't break, but we still had enough time for me to make the a 2 or 2.5 minute pitch to get that foundation to do a program related investment. And I had been jealous of my friends in the community development world, affordable housing world, who had used program related investments. And for some reason, the land conservation field had not taken advantage of that part of the Internal Revenue Code that allows foundations to make higher risk loans, higher risk equity investments, sometimes actually using their endowment instead of their grant budget to do that. So that was the very first conservation PRI. It was done by the Jesse Smith Noyes Foundation. And believe it or not, it was used to acquire land that became the first new little park in New York City in about 40 years. And it was on Staten Island. Not that it's related to the PRI initiative, but it's actually called Hero Park. When I was working for Trust for Public Land, I also borrowed from the oldest land trust in the United States, actually the first land trust in the world, the trustees of reservations, their articles of incorporation and their bylaws, and used that to do the first urban land trusts in Oakland, California, that then migrated across the country. So those are just some of the things I got to do when I worked for the Trust for Public Land. Probably the transaction that caused me to understand private markets and accessing private capital is the last of those bullets, the first public-private partnership in Wisconsin. This was a transaction in the late 1980s when the Forest Service wanted to add land to the Nicolet National Forest, high priority in-holding acquisition, significant scale. It was approximately 10,000 acres. The problem or the opportunity was the seller actually wanted to sell all of their land in 2 operating mills. It was the American Can Company, which was merging into Transamerica Insurance, which eventually became part of Citigroup. And they were enthralled with the idea of a bargain sale. They just wanted to do a bargain sale for perhaps 9 times the amount of acres that Trust for Public Land or the Forest Service really wanted, and they wouldn't separate out just the inholding. So I was a little embarrassed to go to the board of directors and say, well, the good news is we got a great discount, but there's an extra 75 or 80,000 acres in the package and 2 mills that really had no reason to be owned by a nonprofit conservation organization. And it's that's when I met Lyme Timber. I had done a couple of Appalachian Trail protection projects with Lyme Timber when I worked at the Trust for Public Land. And I said, could you come up with the capital to be the acquisition partner? They said yes. And I said, but it's happening so quickly, we need the right to reacquire up to 20% of the land you're going to acquire, because we really have to talk to some Native American tribes, some county forest preserves, state government agencies, to see if there are any other conservation priorities in this bundle of land. And then I was lucky enough to find a broker who could sell the mills prior to the closing. So in the old days, we actually physically showed up at real estate closings. In the first conference room, we acquired the land, and a nanosecond later sold the mills. Second conference room, we sold a significant amount of land. The we this time was Trust for Public Land, sold a significant amount of land to Lyme Timber with this reservation to be able to reacquire what we could identify with partners as conservation priorities over the next 24 months. And then in the last conference room, we celebrated the inholding acquisition that we then waited for about 2 years for Land and Water Conservation Fund money to arrive at the U.S. Forest Service so they could acquire that land from the Trust for Public Land. But that was sort of my learning experience of how to deal with, access, partner with private capital providers. And quite candidly, it was also one of, I believe, the first times a private capital provider created a partnership with a conservation NGO. I kept doing that as I made the transition over to the dark side. And so Lyme Timber's work, with 1 or 2 exceptions, has been to do what we call structured conservation investments, where we are either recruited by a conservation NGO or big regional land trust, or we find 1 or more land trust partners, and at the moment we acquire the land, enter into an option agreement that gives our land trust partners exclusive rights to pursue the conservation transactions that we designed together. And we are either really good at what we do or really, really lucky, because of the about 125 of these option arrangements that we have done with conservation NGOs. Only 1 of them failed to be exercised, and candidly, it was more our fault than our conservation partner. During that time, I also got to do my first projects in Canada, in partnership with Nature Conservancy of Canada, where, if you know anything about that country, one province has a very different property rights system. So we had to create the equivalent of a working forest conservation easement mechanism in a civil code jurisdiction, which is the province of Quebec. So we did the very first working forest conservation servitude in Quebec. We also have a, I used to say tiny, but it's probably slightly bigger than tiny, consulting practice. We've helped a number of conservation grant-making foundations create and then make program-related investments. We've done that for the Packard Foundation, Darstuk Charitable Foundation, Mitchell Family Foundation in Texas, the William Penn Foundation in Pennsylvania, the Sewell Foundation in Maine, and a few others. And we've also helped a number of families, and I'll be polite, but these tend to be families that have some type of intergenerational or family conflict about the future desired status of a really important conservation target. And for better or for worse, we usually get called after the first attempt at conserving the land has blown up. We have done more than 1 million acres of conservation advisory projects with families across the country. The largest was done in Maine, which is still the largest conservation easement transaction to date, but we've done them in many other places as well. As you can see, I've also been involved forever with the land trust community in the United States. I was lucky enough to be part of the meeting that was held at the Lincoln Institute of Land Policy that created what was first called the Land Trust Exchange, that is now widely known and respected as the Land Trust Alliance. I served on that board for many years. I was also recruited to be on the planning committee that created the Accreditation Commission and served a term on that commission as well. A number of you from outside the US also know about another network. I have two favorite networks, the Conservation Finance Network and the International Land Conservation Network. And with Laura Johnson, Jim Levitt, and a host of people from other continents, created that network, which is hosted and housed at the Lincoln Institute of Land Policy about 7 years ago. And I know from looking at the attendee list that a number of you are active participants or beneficiaries of the work of that network as well. So, you know, one of the things I wanted to kind of close up with is really to thank Helen and Jackson, and especially Leigh, who make my life much easier. Before the existence of the network, before we had boot camps, Story Clark and I would do an annual workshop at every Land Trust Alliance rally. So it starts in the late 80s, early 90s. We just did it forever. And we both grew up in New York, and we could talk really, really fast. And we could cover like a significant amount of stuff in 90 minutes. But then we would spend like the rest of the year answering email questions, or in the early years, phone questions, that because we talked too fast or didn't have a lot of resource materials, people would call up and say, what did you really mean by that? Or how does that really work? Well, that led to a gathering that was hosted by Jim Levitt at the Lincoln Institute of Land Policy about 17 years ago, which caused us to have the very first boot camp. And fortunately, Brad Gentry was at that meeting. There were about a dozen academics at that meeting and a few people like me. And we said, well, that means Story and I don't have to do this workshop ever again. And we could spend a whole week talking about this stuff. And so we launched the boot camp at Yale. It's been at Yale, I don't know, 10 times. It's been at Duke, at the Nicholas School at Duke. It's been at CSU Fort Collins. It's been at Portland State. It'll keep happening. Obviously, it's been virtual last year and this year, but we're pretty certain it will be real in New Haven next year. And it's just been a great way for me to sort of pass the mantle of responsibility and sort of resource connections to Leigh and now Helen and Jackson, so that there really is a functioning center or hub in the network, and it's not just, you know, catching me at a free moment or catching Story or Brad at a free moment to answer questions or provide examples, or what we used to call deal doctor, difficult transactions or structures. So I'm going to stop there. This presentation will continue for a while, but I'm quite sure, because I got Leigh and Helen and Jackson to promise, that we'll have 10 or 15 minutes at the end for questions and comments. So take it away, Leigh.
Thanks, Peter. And just to make you feel old or perhaps experienced in your boot camp tenure, this, if we were in person together, would mark the 15th annual Conservation Finance Boot Camp. We're going to call it anyway, as a virtual community coming together. And this is really meant to be an appetizer to the network and to the content that we have to share with you. In the space of a week-long workshop, we really have a much different ability to help you step away from your project work, your to-do list, and start to think differently, start to have some ideation come through to how else you could be approaching the funding and financing side of whatever resource challenge you're up against. So we're going to try and mimic that however we can in the space of this webinar series, but also ask you to get in touch with the network, to use us as a resource, as a hub, to help you accomplish the great impact and mission that you're working to achieve. Something to pull forward from Peter's remarks as I beg for the next slide here is just the extent to which blended capital is something that is the backbone of many of the types of tools and approaches we're going to talk about. And lest blended capital, blended funding, blended financing, if that phrasing intimidates you, I assure you, you are probably already an expert in it. If you are donating, if you are commingling in a project structure, gifts, grants, public-private money, and that can be private philanthropy, not just private investment capital, you are already blending money in some way or another. And we really want to help you understand different ways of doing that, different types of capital that you may not have had as much experience with. So just to jump in with a quick word on CFN, we help practitioners find money for projects by building and supporting a community of practice and increasing the confidence, capacity, and connections across the field. So please put us in and help us help you if that strikes a chord. Next slide. What exactly is conservation finance? So the way we define it is a range of strategies that generate, manage, or deploy financial resources, or very importantly, align incentives to achieve conservation outcomes. So it's really about how you use other people's money to help address your own problems. And by other people's money, we mean public, philanthropic, private, and/or blended sources of capital. So these are all strategies meant to cobble together the financial resources for projects, to create new conservation products, and also the revenue streams associated with those, to create more holistic partnerships with other sectors like health, community resilience, public utilities and infrastructure, et cetera. By funding, we mean money you don't have to pay back. By financing, we mean money you do need to pay back. And blended or layered funding or financing is just a mix of those two types of money. I will also just share a quick note. The language of finance, at least as I interpret it, was invented to intimidate. It certainly helps to justify the fees.
Block of time.
We'll need to mute someone there. All right, and so anytime you are reading about a financial approach and you feel intimidated by some of the jargon, please just remember that it's meant to be a bit intimidating. So a few quick preachy points before you wade into a conservation finance tool or approach beyond what you're already doing. First and foremost, go for the simplest and easiest money. This one we've learned through extensive research, anecdotally or otherwise. Build the solution from the pain point, actually understand what problem you're trying to solve, and be laser focused on how the solution that you're developing, whether within your organization or within a certain partnership structure, is showing up in service to that particular pain point in the market, in the approach, in the landscape, in the community. If you're working with private capital, we like to remind folks there's no such thing as a free lunch. They don't just expect 100% of their money back, but they also expect a return, an additional percentage. As I believe David Hoffer is going to tell us in the next session, it's actually the most expensive lunch money can buy. Another just great point to hammer home, someone somewhere must be willing or able to pay for the conservation outcomes associated with the transaction or project. Some entity, whether it's a consumer, a corporation, a utility ratepayer, a taxpayer, or some philanthropic entity. And then maybe the most important point, partner. You do not need to be the expert. There are specialists out there. There are commercial partners out there who can help with project design, implementation, marketing, communication. I think we try to wear a lot of hats in the way that we approach conservation. And frankly, I think we ought to just consider how better to partner and how better to leverage specialized skill sets. We don't need to do it all ourselves. All right, core strategies. This is just general framing for how we think about bucketing the strategies behind a lot of the players and projects you might encounter in the field. Conservation-oriented real asset investments. This is the buy, protect, or lease and sell models, typically involving real assets or farm, forest land, and ranch land. We also consider environmental credit markets, whether regulated or whether regulatory and compliance oriented or voluntary. So many of you will have heard of payment for environmental services, such as carbon, wetland mitigation, banking offsets, things like that. So too, a core strategy gaining a lot of traction these days, commodity supply chain improvements. And that has to do sometimes with companies, sometimes with other entities, engaging up and down the supply chain for better practices and products. Cost savings and risk reduction strategies. We're seeing new and emerging forms of insurance come online. We're seeing lots of innovation, especially in the US in the context of the infrastructure bill, ways to advance and elevate green infrastructure or nature-based solutions as part of a more holistic approach to what we're up against. Outcomes-based models where you're paying for conservation outcomes, not just conservation projects. And then different ways to think about new or leveraged funding. And that can be creative approaches to philanthropy, using bridge financing to buy yourself time for more traditional fundraising approaches or other forms of capital or grants to come through, voluntary surcharges or other programs like that. So if we go to the next slide, and you're like me, you need things to get tangible real quick in order for your brain to connect with them. So I'm just same list, same set, but just an example to color in a bit. The first, that conservation-oriented real asset investment bucket, you can think about sustainable forest land acquisition. And here I'm just pointing you, I could point you to Lyme timber, for example, but Peter's going to tell you plenty about that. So instead, pointing to EFM, a conservation-oriented timber investment management organization. So too, on Wednesday, so just tomorrow, we'll learn a bit more from Finite Carbon about the world of both compliance and voluntary carbon offset models. When we think about input providers, so here I'm pointing you to Rabo AgriFinance. These are companies, sometimes an input provider may be producing nitrogen and phosphorus fertilizers, and they really are at an impetus to green their footprint. In the case of Rabo AgriFinance, they're actually a farm financial institution, a farm lender who's piloting a premium on a farm operating loan in relation to regenerative, sustainable agricultural management practices. Cost savings and risk reduction. So as a resident of Washington, DC, this is a very close to home one for me, but the DC Water and Quantified Ventures Environmental Impact Bond, which was sold to Goldman Sachs and Calvert Impact Capital, is effectively a green stormwater infrastructure project that's helping Washington, DC through DC Water address our combined sewage overflow problem and our consent decree associated with that. It's repaid by a surcharge on DC Water ratepayer bills. So every month I see a little stormwater surcharge on my bill, which is actually helping to repay this first ever environmental impact bond. And then down under new or leveraged funding, you'll see zero footprint. This is an example of a celebrity chef driven effort to charge restaurant patrons an additional charge on their restaurant bill, which then goes to capitalize a grant program for climate smart agricultural practices. Next slide. So what is the spectrum of different funding and financing sources? This table is meant to help you think through the different types of money out there for conservation. On the left, you can think about some of the more tried and traditional approaches in the land conservation canon in the US, such as tax benefits, which have been the bread and butter of the land conservation movement for near on 40 years. You donate a property or a conservation easement, you get a tax deduction. Also gifts and grants, whether from individuals, foundations, or municipal, state, and federal agencies. In some cases, you can manage land or property that you own to produce income, and some creative ways to think about earned income from there. And then as we start to move to the right, we also start to shift into sources of debt, sources of tax credit, sources of equity investment, or those things Peter was talking to, where you're partnering with a private equity provider. The amount of money out there gets larger, but so too does the cost and complexity of the project. So just an important point to note, And the reason that we say go for the simplest and easiest money first is because the money itself starts to get more and more expensive to use as you shift to the right. But shift to the right, we can and we must. And we're going to try and hammer home both the impetus for doing so and the opportunities for putting some of these tools to use in your work. I'm going to hand things over to Jackson to editorialize a bit. And Peter, you can wade into the fray too here if you'd like to editorialize.
Thanks, Leigh. Yeah, I want to jump in and just draw your attention to that debt column there, because I think that's where the magic happens. As a deal person myself, I think once you're a deal person, you're always a deal person, and Peter might agree. But low interest financing is where you have a chance to compete with the private sector. You can close in a few months instead of years, and on price, you can layer together a lot of these strategies that are on the chart. By slowing down time. Now that you've closed and you have debt, you can layer together multiple strategies. Peter, do you want to add anything?
Yeah, so I think I'm just going to build on what you just shared, Jackson. One of the items there is called state revolving loan funds. I think what we're talking about are the safe drinking water and clean water revolving loan funds. These are essentially grants that came out of federal EPA to each state, matched 90% of the fund came from the feds, 10% came from the state. Conventionally or traditionally used for gray infrastructure, water treatment plant, pipes, things like that. More and more, starting in Ohio and Iowa and migrating to other parts of the country. I live in Vermont, although my office is across the Connecticut River next to the Appalachian Trail in Hanover. We are lucky in Vermont that the SRF, the State Revolving Fund, has been accessed by Trust for Public Land, Vermont Land Trust, Upper Valley Land Trust as an interim financing source. So I would argue that all of you who are working in the US should be thinking about ways that type of financing can be secured. If you're willing to deal with very expensive lawyers and a lot of friction, we can go one column to the right and talk about New Markets tax credit financing, which requires an allocatee, a recipient of those tax credits, to partner with you. Lyme Timber has done that now 7 times, principally with Coastal Enterprises based in Maine, CDFI, Community Development Finance Institution. These really require a larger deal to deal with the friction. So if you're thinking about borrowing hundreds of thousands of dollars or a few $1 million, program-related investments, SRFs, community investment notes, loans from friends, that's a good way to go. If you're talking about $5 million and more, then some of these more, it's not so much that the money is more expensive, it's the amount of time that it will take and the soft costs associated with perfecting the loan that makes it more expensive.
All right, I think
back to you guys.
I think we can move on here. I just put our toolkit on debt and bridge financing and also on state revolving funds in the chat. And we can go to the next slide. Over to you, Helen.
All right, thanks, Leigh and Peter and Jackson. So we're going to kick off into operational and financial readiness. And this, again, is just going to be a primer on financial readiness. Tune in tomorrow for my conversation with David Hoffer from Lyme Timber, where he's going to delve into the principles of finance and give some case study examples and give you all a really, really deep understanding of how this all comes together. So on the operational readiness side, we have lots of sectors represented today, but as I'm talking about operational and financial readiness, we'll be using the land trust sector as our platform for this discussion. So when we talk about sourcing the simplest and easiest money first, we're all pretty comfortable applying it to a traditional acquisition approach. And back to the last slide, we're talking about tax benefits, individual giving, and institutional grants. But when you start looking at the right side of the table, we begin getting into more complex funding sources. And with that, we have to think about operational and financial readiness. So your organization may be looking at a watershed scale project or eyeing a potential partnership with a major corporate entity. These are exciting and complex conduits to accomplishing innovative conservation, but having a pulse on your operational and financial readiness is really paramount to their success. And with the varying levels of complexity and scaled forms of funding and capital, one of our goals today is to help you think about and identify ways to help your organization get to that next step, or really reevaluate your project readiness processes. So under project due diligence, if you're an organization in the US that adheres to Land Trust Alliance's standards and practices and the accreditation requirements manual, having a project process in place should be old hat. But for those of you who want to gut check their process or want to overhaul their process, one critical tool of project due diligence is the project evaluation criteria. And I love the criteria because it gives you the opportunity to look under the hood and say, yes, let's move forward on this opportunity. But it should also give you the opportunity to say no or hit pause. If you're saying yes to every project that walks in your door, are you really looking at it with an objective lens? And can you justify it to your team and your board and to your community? Under organizational support, so the team has evaluated the project and you've identified that we're going to move the project forward. But one question is, who have you identified as part of your team? I bet we have a lot of transaction folks and project managers on this webinar, some deal folks, and I'm really glad you're here, but your project team is more than just your land protection team. So think about your stewardship team. They're responsible for the back end post-closing. Why not bring them in during the project development stage? They bring critical foresight into key and potentially costly land management issues. Let them begin cultivating a relationship on the front end, and it'll likely help your team gain even more confidence from that landowner, municipality, county, or even major donor. Additionally, let's look at your finance team, whether that's your business manager, your CPA, your CFO, your finance committee on your board. Again, loop them in on the front end. Chances are they can offer some real insight you might not have thought about. Keep them updated throughout the project. Don't just give them a heads up the day before closing saying they need to be ready to wire money or accept a check. They're really an untapped resource and can offer your team more than just organizational financial support. And also part of your team, your philanthropy team. They may not directly engage with a landowner or project during the project development stage, but they're in the background creating and implementing that new and innovative funding stream. So lastly, I'll talk about project framework. I appreciate following a process and I love tracking and measuring progress, but as you all know, to a degree, you can't let process stop progress. So set your project up, make sure you have your board approvals, your documentation for legal, but know that so many parts of the project will run parallel tracks. Things will happen before you think they should, or get paused for longer than you expected. And back to the point of introducing more complex funding or financing sources on that right side of that table, board buy-in is critical. You don't want to be educating your board on the use of loans for bridge financing at a time-sensitive point in the project. Ideally, you've already talked to your board about how to use debt as a tool, even when you had no immediate plans to borrow. And in some cases, there may need to be some board education on conservation finance readiness to show that innovative new financing will accomplish more conservation. So let's go to the next slide, please. So again, we're going to touch on financial readiness. And again, the goal is to start thinking about inviting more complex funding and capital into your project portfolio. So the first bucket we're going to talk about is an accounting process. Think about making your organization more bankable and making sure your financial house is in order. And you can start really truly with the basics with your business manager, CPA, CFO, or board finance committee, and evaluating your accounting process against standards and practices, requirements manual, or another similar metric if you're not a land trust. Additionally, your basic financial statements and audited financial statements. As part of your project development, this would be a great time for you to sit down with your finance team, have them explain the implications of a potential new and innovative funding source, how should expenditures be tracked? What about employee time tied to a funding source? You should really lean on your finance team for understanding why a balance sheet and a P&L are critical components in project development. So while you're focused on the next 6 to 12 months of hopefully completing a project, your finance team is already likely thinking about the annual audit in 990. All the funding and time tracking they're asking you to do rolls up into this massive all hands on deck annual exercise. So now that we have the foundation for project readiness, Jackson's going to do a deeper dive into a few of the tools and funding mechanisms.
Thanks, Helen. Yeah, I want to echo your one of your points, which is the fully utilizing your project team. I can't stress it enough that you should be working with your philanthropy team and your finance and accounting and stewardship and your board, because you all have your own strengths, and to be able to play on those makes for better projects. So yeah, the next slide, it talks about debt. And I know Peter talked a little bit about SRFs, and that's the last one, Clean Water State Revolving Funds. But I want to just go through that list because it's sort of a sliding scale on ease of access or about pulling out funds. The bank there is a fair market rate. And while right now interest rates are low, I would like you to avoid going to the bank. There are other opportunities out there that are easier to work with, but also at a cheaper interest rate. The bank probably sees one deal every few years, if that, and so there'll be a lot of hand-holding and explanations, and it'll be pretty time-consuming. I see a few foundations on the attendee list here, so I want to give a shout out to foundations that are able to give program-related investments. Those are PRIs, and they're able to offer a lower interest rate because the return is not just money, but it's also the impact, whether that's social or economic, social or environmental impact. They're able to offer a lower interest rate. And foundations see conservation deals much more than a traditional bank. Next on the list is conservation lender. An example of that is someone like the Conservation Fund. And this is their bread and butter. They know conservation really well. They know the players on your application, and they can even offer technical assistance where appropriate on how to structure a transaction. Individuals, I think, is an untapped resource. There is a limit to what high net worth individuals can loan, but this is worth a discussion with your philanthropy team. There may be an individual who can provide a $10,000 gift, but they could provide a $1 million loan. And so that's something for you guys to consider, for you land trust professionals to consider, is should we take a smaller grant, a gift, or should we have low cost financing? Next slide is, this is the framework of a leveraged transaction. And so I just want to acknowledge that we've been talking about debt that needs to be paid back. And so I'd like to just provide a few examples of the right side of this framework, which is the sources of value or revenue. So next slide is we've got corporate social responsibility. And this is also referred to as corporate philanthropy. This is where a business makes a voluntary gift without an expectation of return. The pros are that every town has at least a business or two tied into the community well-being. And this is an effort that can build durable relationships with your business community, where if you're having regular check-ins, that builds a stronger relationship. The constraints are that you can quickly hit saturation, that there's a limited number of businesses willing to play, and there's limited philanthropic dollars or value as well. So some examples beyond traditional charitable giving, like sponsoring your annual barbecue. There's corporations can provide pro bono technical assistance, like pro bono legal counsel or marketing. Corporations may donate a % of revenue to a cause. One example I've got is Tom's. They used to donate a pair of shoes for every pair they sold, but now they donate 1/3 of their profits to grassroots sustainability efforts. So that's just one example of corporate charitable giving. Another thing that's really valuable is support letters, for whether it's a land protection project or it's a ballot initiative. Having corporate sponsorship or support backing your project is very persuasive to those reviewing your application. Peter or Leigh or Helen, do you guys want to add anything about corporate philanthropy?
No, but just if we went back, one area that is sort of in between individuals and foundations is the growing role that donor advised funds and community foundations are playing. Again, I'll use a Vermont example, but the Vermont Land Trust was able to work quite creatively with the Vermont Community Foundation to capitalize with debt. So these are loans from donor advised funds these donor advised funds are the individual or family philanthropic entities that are controlled and managed by the Vermont Community Foundation. And Vermont Land Trust went and said, well, we have a need for interim financing to buy a farm, hold it long enough to do a new business plan, recruit an expanding or new young farm family, and sell a conservation easement, a farmland easement over the farm. And then when all those steps are completed, the family will be in a position to acquire the farm using long-term debt, and we can repay the loans from these donor advised funds. But that Vermont Land Trust is not the only land trust that is accessing donor advised funds. So I think that's something as you and your philanthropic colleagues within your organizations develop relationships with community foundations, that's something to begin to explore.
Thank you, Peter.
I'll just underscore that. I for those interested in more on donor advised funds, just dropped an article into the chat box. And before you move on, Jackson, one point that our colleagues at EDF have been pretty good at making time and again is to think about corporates, yes, as a source of potential partnership and capital funding, that is, but also sometimes the power of their advocacy as being more important than the philanthropic contributions they can make, especially where state appropriations processes are concerned, or where they have a little bit more heft and influence than you or your organization might have. So we do typically think about corporates and businesses as a source of money, but I think so too, not limiting our aperture and thinking also about a source of influence or access to other types of money.
Excellent, thanks. Helen or Hallie, if you could go to the next slide. We've got voluntary surcharges are the next frontier of value creation. I know a few of you here in the room are involved with voluntary surcharge programs in your landscapes. So this one, and I'm noticing a few people in Colorado where I am. And so this, I want to shout out that this is best for communities with nature-based tourism, targeting visitors and not residents. What it is adding a small fee onto a customer's bill. So the customer must opt out of the payment. And there's been numerous studies showing that nearly all of us, and I'm speaking from personal experience, will go with the flow. If the fee is on the bill, I'm not going to opt out. I'm also not going to opt in. These programs come in a lot of shapes and sizes. There's you can add a percentage of the bill, such as 1% fee on the purchase of a backpack or dinner. There's flat fees, such as $2 per night on a hotel room. Some programs have one business, like a large hotel chain. Other programs is a smaller geography, but a lot of participants of the business community. Some programs are enduring, long-term, others are short-term, even just for a day. So one example is Cherry Republic in Michigan. They do a little bit of both. They do a refundable 1% off the top on all purchases. and that amounts to about 50 to 75 cents per transaction. But they also, they donate $1 from every sale on their gift baskets. And so they have 2 different voluntary surcharge programs going on there. The next slide, Hallie, is ballot measures. This one is a huge source of funding. I think about $4 billion in 2018, and again, another $4 billion in 2020. The challenges are that it requires a significant amount of time and expertise and money, extensive research into the funding needs for that geography, determining compliance with state law, evaluating the political climate and financial feasibility, lots of public polling. So this is a really heavy lift. The good news is that organizations like TPL are very good in this space, and they welcome really diverse partnerships to scope out new opportunities. So if you're thinking that your community may be ripe for this opportunity, you can reach out to me or a contact that you know at TPL to start stirring the pot there. One recent example, another Colorado connection, in 2020, Denver passed a climate sales tax. It's a 0.25% tax increase that's going to generate an estimated $30 to $40 million a year. And that is ballot measures. Since we're short on time, I'm going to just move on to carbon credits, and I welcome questions at the end. Carbon credits, I'm going to be brief here because Trevor from Finite Carbon is going to cover this in more detail tomorrow. And you could also spend days learning about carbon and carbon markets. So briefly, you can earn credits by avoiding conversion or improving the management of forests or grasslands. So that's avoiding conversion or improving management of forests or grasslands. And buyers can be compelled to do so by government regulation, like California, or buyers can do so voluntarily. One key takeaway from this quick speed round on carbon, and we talked about it in our ground rules, you do not need to be the expert on the inner workings of carbon markets and all the protocols. There are a lot of well-respected and well-regarded project developers in the carbon space, and they're really good at helping you along the way, coaching you up towards a successful project. So please reach out to me. There's a few of you I see here on this session that have done carbon projects, and I'd be happy to connect people if you're thinking about a carbon project. Next slide is other potential revenue streams. I'll give one example is equipment rentals. I can't remember the state, I think it's Oregon. There's a conservation district there that used an SRF loan to purchase a no-till drill for themselves, and they rent it out to farmers in their landscape to use the rental income as a repayment source for the loan. And this gets more people enrolled in cover cropping, and it increases the impact to water quality in that landscape. And that was one of the barriers they saw was access to the equipment. And so they took out the loan to buy the equipment and rent it out. Next slide. We've got blended capital. And I want to start by saying, I think all of you are experienced with blending some capital. We've got, all of you, I believe, are really familiar with public grants and also grants from private institutions and also philanthropic funding and charitable giving. So that's blended capital. But blended financing, that term is throwing money into the mix that must be paid back. That's the low cost financing. So what gets blended? Philanthropic dollars, they're the fastest, usually the first money in. Public dollars have, as you guys know, have a lot of rules and restrictions and strings attached. And then private capital can move fast when the right deal comes along, almost entirely finance first. And so what makes this work is the low cost debt, but also the public grants and other risk mitigation tools to attract private capital. Impact, we talked about PRIs, impact investment is aiming to achieve not just dollar returns, but also social or environmental outcomes. And that's why they're offering below market rates. And then returns, private investment is expecting financial returns to match market expectations. And where's the last one there? Where is it being used? In many or most conservation finance projects and collaborations, you're seeing a blended of public grants, charitable giving, and then blended financing is adding this profit-seeking capital. I'll pause for a little color from Peter and Leigh and Helen, but I'll provide in the next slide what this looks like in practice.
Yeah, the only thing I would add is it truly is being used across the landscape. And while for many of you who know Lyme timber, we tend to work in pretty remote rural areas where we're collaborating with conservation NGOs, state and federal agencies, using new markets tax credit financing. So we do a lot of blended finance transactions. At the same time, it's being used in intensive urban applications. You'll hear from Greenprint partners tomorrow, where they are doing distributed green infrastructure with a layer cake approach to financing how the capital expense of that infrastructure is delivered and implemented. So I don't want anyone to come away from this that it only works in a forest, or it only works on a ranch, or it only works in remote parts of the US or remote parts of the globe for that matter. It works in urban areas as well. And I think that's important because, think about the last 18 months and access to nature and the need that we're seeing and the voices we're hearing from, I would argue, a larger array of stakeholders for conservation because of the value of access to open space during COVID. So that's all I wanted to say.
Thank you, Peter. Next slide is, I think, setting the table for what a leveraged transaction looks like. So this is an example. I've changed the name to Happy Valley Land Trust, but this is a transaction that has occurred. It's about 300 acres between town and a state wildlife area, mostly forested, a series of vernal pools. The seller had owned it for a really long time, about 4 decades or so, and they had a significant tax bill. And just to put easy numbers, 1 million fee simple and 500,000 for the conservation easement expected value. And the seller wanted to move fast. They always do, don't they? And so if you go to the next slide, you're going to see the framework. This is just a. You go to the next slide. Yeah, here we go. So I just wanted to go around the horn and just show you what the transaction looked like at the end of the day. So equity, and you guys, I think, are familiar with these tools. Their equity was a bargain sale. The seller donated a percent, I think it was about 5%, off the top of the sale. And so that was some of their equity. They also had some of their traditional philanthropic campaign thrown towards the down payment. And they also held on to some of those dollars as reserves. If they had to service debt payments or fix fencing, they held on to some of their cash in hand. They also got a couple of small grants that were available at closing time. There were some grants that weren't available at closing time, and so they got a letter of intent to 2 public agencies saying, we want to apply for these programs, but your calls for solicitations, your RFPs don't come out until after closing, and we can't delay. So we'd like to preserve that that threat of development. And they got the letter signed by both the public agency and also the land trust. The financing, they got a little blend. Sorry, my cat is attacking a bag of cherries next to me. The financing was 2 different pools. They got a loan from a board member or a friend of the board member to give a $500,000 loan at the imputed interest rate at that time was about 3%. And the board member pledged to donate those interest payments. They said, whatever the interest payment is, I pledge to cover it. And then they also got a PRI from a private foundation for the remaining debt, and that was 5 years at 1% interest. So at closing, they had the low cost financing, and they had some equity from the bargain sale and a couple of grants, and they had the letter of intent with a couple of the grants. For income, they did a conservation easement and got some of that funding with the letter of intent. And they also did a recreational lease. They did a fishing lease with the state Fish and Game office. So they got a short-term lease for a limited amount of folks to do. It wasn't Boy Scouts, but it was like a children's group to go access the river for a few days out of the year. And then finally, the transfer out, they sold to a private conservation buyer, and they were, I think it was 2 years in, and there was some appreciation at that time. And so they ended up returning somewhere a little less than $200,000 that they were able to recycle from that private giving that they raised. They were able to return some and roll over into the next deal. So that's just one example of a blended transaction. I'm going to pause there. I just wanted to just show how you would use different flavors of money, debt and income, conservation easements and leasing in one transaction. So I could, Peter, if you want to add some color to a blended transaction, or if you want to start seeing if there's any questions in the chat.
I think maybe with Leigh's help, we should just open it up for questions and comments. There have been a lot of questions in the chat already. I do think there's really interesting work going on by American Forests and Trust for Public Land and a number of other groups around issues like tree canopy, tree equity. There's a remarkable land trust that I am a giant fan of that operates in northeastern Ohio called the Western Reserve Land Conservancy, that's doing very interesting things both in Cleveland and in some other older cities in that part of Ohio. In that case, there is a role for carbon credits. There's a role for concessionary financing. If any of you are familiar with Detroit, you'll know about Salesforce, so corporate social responsibility investments by Salesforce in Detroit for urban forestry. So just definitely want to make sure that we don't leave cities out of the mix.
Right. Well, with the 10 minutes we have remaining, definitely going to buy a little time for anyone that wants to throw a question into the chat box by starting off, Peter, with what is really a 3-hour-long conversation, but we'll try and get it in 3 minutes. So folks who are listening in, they may be wondering, where do they start, or how do they take their exploration further? So that could be generally for their organization and trying to get their colleagues, leadership, and board up to date, up to speed on what beyond somewhat traditional easement or acquisition programs and sources of funding they should kick the tires on. So thinking a little bit more holistically and expansively, or even how do you know if you have a promising project? Where do you start? If you think you might have something that would be promising for the consideration of opportunities for leverage, opportunities for financing. So just in either scenario, kind of the organizational capacity and exploration onto like, do you have a project? Or, is there there for something you're trying to solve?
I think Helen touched on it in some of the readiness discussion that she laid out. I've had the experience, because I've been part of every one of the boot camps, where we will have someone who took notes, paid attention, might be the executive director of Land Trust, maybe conservation director of Land Trust, and gets remarkably enthusiastic about some extraordinarily complicated financing structure. goes back to the land trust. Maybe there's a land committee of the board that he totally confuses. And then the full board gets confused, and a roadblock or at least a significant speed bump develops in implementing some of the practices and strategies that we've been discussing. So before you want to actually use it in a transaction, these new innovative mechanisms or compilations actually of multiple innovative mechanisms, I think whether you're sharing some of the recordings that we're producing, whether it's some of the resources that Leigh and Helen and others have been populating the chat with, whether it's using that discount from Island Press, full disclosure, founder and former board member of Island Press, so that maybe everybody reads Story's book, A Field Guide to Conservation Finance. While it was published a while ago, it is not outdated. There's still stuff that is important in there. So I just want to make sure that that there is an appetite and a pathway between the board and staff of the land trust to explore this. We've also had the exact opposite happen. It's a great land trust in Colorado. We had the board chair come to conservation finance boot camp in one of the early years. He had a great time. He too took a lot of notes, and his staff was not ready to pursue the kinds of transactions that he learned about. So I just want to second what Helen touched on, which is build what I would call comprehensive readiness on the volunteer side and the staff side of the land trust. The other thing, and it's might be viewed as minor, but Helen pointed out, and I think it's really important, which is I would argue that the Achilles heel of land trust work in America is stewardship. Everybody can get excited about a closing, about a transaction, but while humans aren't perpetual, conservation easements are. And the ongoing financial liability, I'm sorry to use that word, or obligations associated with easements really have to be baked into the upfront conservation finance aspects of the transaction. So are you building a stewardship fund as part of the transaction acquisition fund? Are you truly understanding how remote sensing technology might make some of your stewardship work over the years a little easier? So while not everybody puts stewardship into conservation finance, I think it's a really important thing to build into project development. As far as getting started with deals, I'm old enough to remember random acts of conservation. Like, why wouldn't you fall in love with that piece of property? As opposed to strategic conservation planning by land trusts that creates a sense of priorities, some of which might not require a tremendous amount of creativity. They just may require dozens of cups of tea or coffee around the kitchen table with a family, and eventually convinces them either through estate planning or during their lives to do the right thing conservation-wise for their land. But for those families that don't get it, or where the property is being marketed by a broker or an investment banker, you have to be ready, and it has to fit into a rational or logical strategy for your land trust. And certainly there's plenty of information on the Land Trust Alliance website. There's been some great work around resilience by Open Space Institute, Hysted, the Nature Conservancy, building those kinds of qualities into land conservation strategies for land trusts. But I think it's really important, and quite candidly, as a private investor who partners with land trusts, we kind of expect our land trust partners to have figured that out. It doesn't work for Lyme Timber or even EcoTrust Forest Management or the Forest Land Group or anybody else to talk about a conservation priority as a private profit-seeking partner. It is much more authentic, much more credible for the land trust to talk about the conservation priority. So we are beholden to land trusts to be sort of the gatekeeper of science and the gatekeeper of community priorities. And we want to harness that and make sure that if we're investing with a land trust and we're dependent on ranking number 2 or 3 in that state for forest legacy, that they've come up with a transaction that's going to rank very high. So let me stop there.
Well, Peter, I'm going to punt right back to you with a question from Brian Garcia. My fault for asking him for a hardball question. So he asks, what are the terms, for example, price, years, credit quality of buyer, et cetera, that must be achieved between an environmental market commodity in order for it to be bankable as a source of revenue in a transaction? And then as kind of a second part of that, have you seen any bonds issued against voluntary environmental market commodities?
Well, the second question is easy, no. For what I would call the compliance or regulated environmental markets, which, while Lyme timber may seem innovative, but we're really not all that brave. So our capital tends to be deployed when there's a regulatory driver to create a market. The best examples of that would be the Federal Clean Water Fund, so the Section 404 permitting for wetlands or stream impacts, or the Endangered Species Act, where the permit authority rests with the U.S. Fish and Wildlife Service. So if you are degrading or destroying critical habitat for a listed species, there is either going to be a refusal by the agency to give you a take permit, or you're going to get a take permit with mitigation requirements. And it's because of those two federal regulations, and Florida, California, a few other states have state regulations that are pretty robust as well, that we're comfortable seeing our capital deployed, and many other, whether it's RES or EIP, or there's a significant number of capital players. So far, debt has not been used to any great extent in those markets. I think that's more due to laziness than anything else. I think if you had asked that question 10 years ago, there'd be a really good reason. They weren't at scale, but now they are at scale. And I think there probably are debt products that could be developed. Maybe there's a green bank in Connecticut that we could have a conversation with.
Maybe. All right, I think we'll just sneak in one more with a quick answer. And this is, I think, probably something that resonates with a lot of the land trust community joining us. Just elaborate for a hot second on the range of values or sources available for conservation easements.
And let's just be, there's a big asterisk. We're not talking about syndicated easements, the ones that cause people to go to jail or should cause people to go to jail. We're talking about principally public agency purchase of conservation easements, where there's a fair amount of experience. If any of you are having trouble falling asleep, please go to landvote.org and you can find all the easement funding programs in America. Depending on the land use regulatory regime, if you have really strong land use controls, arguably those are going to translate into lower value conservation easements. So conservation easement is valued based on what is the land worth without an easement, what is the land worth with an easement, and the delta is the value of the conservation easement. If you're in Oregon and you're outside, or on the wrong side, meaning on the rural side of an urban growth boundary, the conservation easement may be pretty low. The value of a conservation easement may be pretty low, 15, 20% of the before value. If you're in the 6 million acre blue line polygon of the Adirondack Park, which is not just a state park, but it's also a regulatory regime in northern New York State, our experience is conservation easements are 25, 30% of before value. If you're in eastern Tennessee, where the communities don't even have zoning, or northern New Hampshire, I don't need to pick just on eastern Tennessee, conservation easement values might be 50% of the before value, because you have unfettered development rights in the before case.
We do have more questions that we're unfortunately not going to be able to get to because we want to keep people promptly to time. But Peter will be back with us for other sessions this week. And we can also help you get some insight through as well. We will stop there for the first session of the four-parter. We're going to be back on in just 45 minutes at 4 p.m. Eastern for the principles of finance, which will be, I think, a really nice gamification mindset of an investor deep dive into where the actual math comes from and how an investor thinks about the sale of a conservation easement, for example, in terms of how they calculate their return for entering into a partnership and transaction for conservation. So stay tuned for more in just 45 minutes with Peter's colleague, David Hoffer. And if you're missing us for that session, we'll be back on at 5:30 Eastern for the happy hour. But for now, plenty more to come. You can book 30-minute follow-up sessions with Helen, Jackson, or me directly. We missed that slide right at the end there, but we'll get you the links to book follow-up with us. And from there, I'll just thank my colleagues and co-presenters, Jackson, Helen, Peter. This has been incredibly rewarding way to kick off the series and to bring folks together. Thanks for sticking with us through the 75 minutes, and we'll look forward to seeing you again in just a couple of minutes. Thanks all.